Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. Let's take a look ahead to the US jobs report released on Friday, the 8th of March. And certainly what we're looking for here is something to point towards the possibility that the Federal Reserve might want to bring forward their rate cuts or enact a greater amount of rate cuts over the course of this year. Whether it's likely or not, that remains to be seen. But I want to take you through a handful of charts in terms of the economics and what I'm looking out for and what markets are looking out for, and then look at some key markets for us to potentially trade around. First and foremost, I wanted to bring up the outlook in terms of market expectations. This is according to Trading Economics. So the prediction is that we see a drop down from 353 to 195 in terms of the headline payrolls figure. Bear in mind, 353 is not a necessarily normal number right now. The pop that we've seen over the past couple of months is expected to normalize soon enough. And this is the month that we're expecting it. A drop back below 200K wouldn't necessarily be a big problem unless we saw it collapse. But bear in mind, we have seen such strength recently anyway. Arguably, you could say that it all evens itself out. Unemployment expected to remain at 3.7%, with the U6 metric, which essentially is total unemployment. It includes people that have taken themselves out of the jobs market entirely. That's expected to rise up to 7.3%. Average hourly earnings will be a key one once again. These essentially wage figures are a good sign of where things stand from a sort of underlying inflation perspective. The Federal Reserve, alongside the likes of the ECB and the Bank of England, will be keen to drive down those wage figures to a greater extent than is currently underway. I mean, look, last time around, we saw 0.6% on a monthly reading for January. The Federal Reserve will want to see a much lower number on a monthly basis than 0.6%. And this time around, we're expecting 0.3. So some normalization in terms of that. Expectation is that we drop down to 4.3%. But of course, this is still well above the inflation rate in the US. So there's still underlying inflation pressures, and we need to see those wage figures drop out. In terms of some of the charts I wanted to show you, first and foremost, this is the unemployment rate. We've inverted it here and essentially tagged it on with the likes of the job openings number and the US core CPI. That relationship essentially broken recently, with core CPI and job openings drifting down as we see some of the heat taken out of the economy. But unemployment, crucially, has remained low, and that is a positive for the US economy. We haven't seen that surge in terms of unemployment, but this essentially takes the heat off the Federal Reserve to need to cut rates too quickly. That's in part why we've seen markets shifting their expectations away from, say, a March rate cut and towards a June rate cut, because there's just not necessarily the kind of emphasis and pressure on the Federal Reserve to take that proactive stance. The bottom section shows you the rebound we've seen recently in terms of payrolls, a break out of that zone that we're seeing here, which is essentially the pre-pandemic zone, and now with elevated numbers. In terms of that unemployment rate, you can see here essentially remaining relatively flat in terms of unemployment over recent years, whilst we've seen some uptick over the course of the past year in terms of this relationship between the Conference Board, the jobs hard to find, and the jobs plentiful ratio. That has actually seen plenty of chop recently and doesn't necessarily point towards big uptick in terms of unemployment. And ultimately, we're not seeing it yet. So if we saw a big surge in terms of unemployment, then that's something different. But in actual fact, we're not necessarily seeing that come into play. We're seeing very low levels of unemployment, sort of historical levels that we can see pre-pandemic, very similar levels to where we are at the moment. So not necessarily the same kind of pressure that might be needed to push the Federal Reserve. Alongside that, there's something worth bearing in mind in the recent payrolls numbers that we've seen. Like I said, 353, the last announcement, second month in a row, we've seen a figure above the 300K mark. But as we can see on the top here, it appears to be the case that we're seeing this primarily driven by new people taking on a second role. So part-time roles, as opposed to a big jump in terms of full-time employment. That points towards a possibility that people are taking on second roles for them to deal with this elevated inflation rate. So, you're talking about the potential for double counting here when it comes to the payrolls numbers. So you could say, okay, 353, wow, the economy is absolutely firing. But at the same time, if that's all coming from people that need a second job to be able to keep up with their payments on their car or their house, or to be able to afford everyday items nowadays, that's not necessarily the same position as a massive continued surge in terms of full-time employment. So that's something to be keeping an eye out for on Friday. If we see strong numbers, are they just driven by part-time jobs, or are we going to see another uptick in terms of full-time employment? And then this is a chart that I find particularly interesting at the moment. So the top end of this is the expectations for where interest rates will be by the end of the year. That's in green. So what you've seen here is that the back end of last year saw a big shift in terms of expectations towards ever increasing cuts over the course of 2024, to the point where we ended the year, we were talking about 7 rate cuts in 2024. It didn't necessarily make sense, but ultimately markets got a little bit carried away. And the Federal Reserve over the beginning of this year have done their best to try and rein in those expectations. And it's got us to a point where markets are now expecting just 3 rate cuts this year, a big shift from the 7 that we were in recently. Now, having overlaid that with the US 10-year yields, we can see this very close correlation. So if you're looking for a shift in one way or another in terms of rate expectations, that will likely be reflected in treasury yields. And then we can see a relationship between this, because as you can see on the bottom section, there's a close correlation between the likes of gold and the US dollar index. We can essentially see that, and I've got gold inverted here. We can essentially see that if you're expecting to see a continuation of what we're seeing at the moment, i.e., instead of us seeing around 3 rate cuts this year, do you think the inflation is going to move higher and it's going to push the Federal Reserve into even less interest rate cuts? Do you think this is the end of it and we're essentially going to see them maintain it at 3%, and some of the heat is being taken out of the treasury yields, some of the heat being taken out of the US dollar? Or do you think that we're going to move in the opposite direction? Do you think in actual fact we're going to see the US jobs market and the US economy start to flash warning signs and inflation comes down quicker than expected, and therefore we see a reversal of that move that we've been seeing at the beginning of this year, and people start pricing 4 or 5 interest rate cuts? In my mind, I don't necessarily think that we're going to hit the target, the 2% target in terms of inflation, until the back end of the year. So markets are currently pricing in a June rate cut. I don't think that we're going to see inflation, certainly in terms of CPI and core CPI, back at that level by June. I don't actually think we're going to see core PCE there, but we're going to be close. So I would say in terms of the direction of travel, the more likely event is that we see a little bit further upside in terms of these 2024 rate expectations, where markets expect rates to be by the end of the year. That would point towards a little bit further upside in terms of the 10-year yield. That would point towards further upside in terms of the US dollar, and a bit of downside sort of hesitancy in terms of gold. Gold doing particularly well at the moment, and it's something I will chart within the show. But placing this within the context of the jobs report, of course, if we were to see something that makes everyone think that the US economy is doing particularly well, given what's happening in terms of inflation at the moment, and question marks, as I have myself, around whether the Federal Reserve will get inflation down to target by June. If we see particularly strong numbers coming out of the jobs report, then that would likely cause markets to continue this trend in terms of upside for rate expectations, upside for the 10-year yield, upside for the US dollar, and a potential pullback for gold. The inverse is if we saw, say, a particularly significant slump in terms of payrolls, and if we saw a wage figure move towards the downside, then people might think, well, this is great. You know, we're essentially seeing the economy start to tighten to the extent that the Federal Reserve are going to have to act sooner. And we're seeing inflation pressures come off, and therefore we're likely to see a move in the opposite direction. That would mean downside for rate expectations, downside for the 10-year yield, downside for the US dollar, and upside for gold. So those are the 2 ways that it might play out. But let's look at some of the charts and see some of the key markets that you might want to trade around this event. Let me just maximize this. So first and foremost, I wanted to show you the US dollar index. This is the key market to be looking out for. What we've seen here is this market's moved from a highly trending market over the course of 2021, 2022 into 2023 and now this year, where we're seeing a lot of chop. You're seeing lower highs, lower lows, then higher highs, higher lows. Now we're starting to look like we could set a new lower high. And so plenty of choppiness here. What I would say is that we're kicking off recently with a move towards the downside in terms of the US dollar. That comes off the back of the beginning of this year where we saw that realignment and money started coming back into the dollar as we saw rate expectations tempered. And that's starting to ease now. And in part, that's starting to ease because of the fact that markets are hitting record highs. You've seen the expectations of markets that used to be 7 rate cuts, and the Federal Reserve was saying, we think there's only going to be 3. Well, markets are now pricing 3. So the argument for greater upside in terms of the US dollar has certainly weakened compared to where we were earlier on in the year, where they had lots of work to do. You know, we could now get into a position where the Federal Reserve are talking up the idea that they're going to cut rates in 3 months' time. And that's bad for the US dollar. So at the moment, looking like we're rolling over, I would say from a longer term perspective, you know, if we are moving in, or we are moving in a year where we're expecting to see equity markets doing well, it's an election year, that is typically the case. We're expecting to see those rate cuts come into fruition later in the year. In the absence of a resurgence of inflation, you would think that this year should be one that is to the detriment of the US dollar. People aren't necessarily heading out for that haven asset. You can see here we've rallied up into the 61.8, folding over at the moment. The daily time frame does caution you on that perception though, because what we've seen here is sort of, this will be a shallow retracement. I should have grabbed that. Let me just, I've got these tagged on here. So we've got shallow retracements up here. So there we go. Well, so it's about 50% to be fair. Then we've got a, I don't think it's a deep one. I think it's another 50%, 61.8. And now we're coming into what looks like another deep retracement. If we were to, let's just grab that deep. If this is perceived to be a retracement. We've come past the 61.8, so that's your first sign that maybe this isn't a retracement and this market's essentially just going to roll over from here. The next area of support is, here we go, it's around 103.4, which is the 76.4 fib. Essentially, we need to break below this structure of 102.9, 102.8. That zone of support that we have back down here is going to be key, because if we break through this zone, then essentially it looks like this bullish resurgence phase is over and we're heading back towards the downside. And this jobs report is going to be key in that. Certainly if we see some strong numbers, then that should lift the US dollar and provide this as sort of point towards this as a retracement before we head higher once again. But let's just look at some of the various markets that you can trade against the US dollar and see exactly how things are playing out. First and foremost, though, let me just show you exactly where things stand in terms of 2024 thus far. You know, what are the winners, what are the losers? So if you're looking for US dollar strength because you think that the jobs number is probably going to be pretty strong, even if we see the number of 195 or something around that, that's still strong. And certainly if you average it out over recent months, you know, you're talking about some significant strength in terms of the US jobs market. Inflation remains a problem. Maybe we're not going to see 3 rate cuts this year. Maybe we see 1, maybe we see 2. Well, that could be a dollar strength story coming back into play once again, despite the recent pullback that we've seen. And therefore you could see, you know, what do we want to trade that against? Well, the weak story has been the Japanese yen. So let's just plug in dollar yen. Well, see exactly where we stand on dollar yen. So long-term trend, very convincing. Coming up into this big resistance area though, so that is something worth bearing in mind. So prior highs up there, 152 essentially. Daily time frame, we can see here currently in a sort of holding pattern. There you go. Comes off the back of a sort of multi-leg move towards the upside though. So you expect to see this either retrace or consolidate, right? So that could come into here before we push higher, or you could see exactly what's happening now, right? Which is essentially something like this, right? Just a tight consolidation. I mean, bear in mind that markets don't move in straight lines. So we're looking at a retracement, but the retracement's taking the form of a consolidation. So what you're looking at here is the potential for a breakout through 150.8 to signal that next leg higher. But bear in mind, 152 up ahead. A pullback would point towards, let's just get this line here. A pullback into this zone would be likely deemed a potential buying opportunity for those trend traders as you're looking for a move into a deep fib. 147.8, 147 looks like a potential buying opportunity if we get it. But at the moment, I don't necessarily see it. And certainly if we see strong numbers, then you're looking at a trend that has been very consistent of late. We're consolidating, but consolidation instead of a retracement is a particular sign of strength, because you could just say this is essentially just a shallow retracement, right? So 23.6 retracement we're seeing at the moment. That's a sign of strength. And if we break up through resistance, that's where you can potentially look for longs. But bear in mind, we've got that 152 up ahead. So that is a warning sign, because we do have another major hurdle up ahead. But things still remain positive on this front. In terms of a market for us to be looking out for, alongside that, I just wanted to point you in the direction of the pound against the US dollar. So cable, this is the weekly time frame. We've got a long-term downtrend in play. We're regaining ground at the moment. And the question mark here is, are we going to sustain these gains? Now, bear in mind, I think over the coming months, we're going to see UK inflation collapse just due to base effects. It's pretty predictable unless we see a resurgence. So it's worthwhile bearing in mind that whilst we're rallying at the moment, there's a good chance that US inflation remains a problem. US economy remains strong, and the UK moves into a position for a rate cut where the US might have to hold off. And therefore, this area looks like an area where we could see this market roll over. Now, in terms of near-term price action, we can see here that we have got this sort of pattern of lower highs coming into play once again here. Let me just get the fib and show you. Well, I need one of my deep ones. Deep. There you go. So we've actually come through the 76.4. Let's look and see if this trendline resistance holds. Up ahead, we've got another trendline resistance. I think there's a good chance that we are going to see weakness in terms of the pound because inflation is going to come down in a meaningful way. The only caveat here is, are we going to see that resurgence in terms of the US dollar? Well, equity markets doing particularly well at the moment. We need to see greater upside in terms of those rate expectations, like I said, and greater expectation that the Federal Reserve is going to have to hold off. And the jobs data is going to be another part of that. I wanted to touch on gold quickly. Bear in mind that I am bullish gold. I have a long-term view that is, we are moving into a phase of rate cuts. And typically from a historical perspective, rate cuts are beneficial for, and monetary easing is beneficial for gold. And so essentially, even during this whole period, we have held up relatively well. We've seen some chop, but it now looks like as we're approaching this period of monetary easing, it's really starting to let go. We could see this tempered somewhat if we see strong jobs numbers coming out. But for the time being, we've got this very clear uptrend in play. And therefore, if we were to see some weak US jobs data, we could see this market push sharply higher from here. 2110 is the near-term support level. Given how extended we are at the moment, if we see strong jobs numbers, a break below that level could point towards a wider retracement in play at the moment. But for the time being, we've got a very convincing near-term trend as we approach record highs here for gold, and coming off the back of this consolidation phase, I think that 2024 is going to be a very good year for gold going forward. Let me just quickly, finally, I know this has been a long one. Let me just quickly let's just do SPX actually. So let's look at the S&P 500, the 4-hour chart. Here we go. Shows you, of course, we've been hitting record highs on a habitual basis. This just shows you how consistent this trend is. You know, ultimately, this market doesn't really care that much about whether we're going to see 3 rate cuts or 2 or 4, because as long as those tech stocks are chugging, this market keeps going. And the tech stocks, whilst it's Nvidia that's driving things at the moment, and Meta, you know, I think there's a good chance that we do continue to push onwards and upwards. And in particular, if we were to see, you know, the high expectations of rate cuts in the near term, you know, it would be good for this market. But I don't necessarily think that it undoes it if we were to see a strong jobs number coming out this time. You know, I'm not one to bet against a trend that looks like this. If we're looking towards the downside, these are the levels to watch. If we were to get a reversal signal, 50, 57, 49, 46, 49, 20, those are the levels to watch. If we break through there, then yes, we could pull into a wider retracement here. But I personally don't necessarily see that happening. And I don't necessarily like betting against trends that look like that. A trend is your friend. And therefore, I like to be on the side of that trend rather than trying to play any counter trend move, because you don't necessarily know how long they're going to last, even if you do get it right. So it's better to play the trend and try and expect something that has happened before to happen again, rather than what's currently in play to reverse, which can leave you with your hands burnt. I hope that's been useful. I've covered quite a lot in this one. The jobs report will be an important one, but ultimately it feeds into this narrative around US economic strength and a recent trajectory in terms of rate expectations that has seen markets increasingly price less and less and less rate cuts. And that could continue if the US economy keeps improving, and if the inflation picture doesn't return towards that 2% target, which I think, you know, we're looking at Q4, quite frankly, if my calculations are correct. So that could point towards further upside in terms of the US dollar, despite the pullback that we're seeing at the moment. Thanks a lot for joining me, guys. Have a great day.